Sometimes it pays to take a closer look at our assumptions. Now, they might conform to the conventional wisdom, but that doesn't mean that they are wise. That's especially true these days for investing, as uncertainty grips the battered financial markets. Now, what's the really safe thing to assume now? Joining us from Seattle is radio show host and chief investment officer with Bulwark Capital Management, Zach Abraham. Zach, at the time of this interview, Monday, the 6th of April, the equity markets were rallying. Now, should investors plan on a long bear market and just sell at times like this?
I think raising, first of all, I hate saying this, I think a lot of it depends on where you're at right now. A lot of it depends on how you were allocated prior to this, how big of a hit you've taken. If you've taken a full hit and you've taken it on the chin, I would use days like this to build up cash. So not crazy amounts, but on a day like this, take some profits. Maybe sell 5-6% of your long positions. Start building some profits. I think, I guess the one thing I keep coming back to is I think at worst case scenario, I think you'll get more attractive entry points and more attractive pricing, and that will help offset some of the hits you've already taken. I also think it'll help minimize any losses going forward. And then also realizing, I think that's one of the toughest positions, Scott, honestly, to be in right now is what to do going forward if you've taken the full brunt. Because if you don't acknowledge that it's least possible for the Fed to overwhelm asset prices while the underlying to overwhelm asset prices with cash while the underlying economy struggles, I don't think it's likely, but it's absolutely possible. And the last thing you'd want to tell a client to do is, sit here and lock in a 20-25% loss and watch the Fed just jigger markets higher,
Zach, is it too late to reposition a portfolio that right now is heavy in equities?
Right, not at all. Not at all. I don't think it's too late at all. Look, again, go look at the S&P 500, right? You've still got a market that's trading at an 18 price to earnings ratio. And I think that price to earnings ratio, even if bad things don't happen, I think it's going to go substantially lower based on the historic spread between GAAP and adjusted earnings. I put it this way: you're at an 18 price to earnings ratio with record corporate debt on corporate balance sheets, a record long bull market coming off of record high valuations, 8 out of 10 metrics. The other two still being in the 85th percentile in terms of expensive markets. And you're going into the greatest economic shock in U.S. history, where we will see the highest unemployment rate since the Great Depression. So if you just look at it like that and you put it in a historic frame, I don't think that there's anyone out there, right or wrong, that if you laid it out like that would fault you for taking profits in the or taking some money off the table in a big bear market rally, which is what this currently is.
Finally, what signals are you watching that might indicate a steady market rebound at some point?
I think you really have to take your eyes off the broader indexes and really start paying close attention to valuations and really start looking at those valuations and then think about them in the context of the at least quarter or two that we're entering, and realizing that it makes no sense. When I start seeing good companies, I'm not talking about crap, but when I start seeing good companies priced as if we're going into a recession, right? Seeing significant drops in projected earnings, seeing just seeing things that are priced like we could be facing a massive economic problem. On a valuation basis, that's what's going to bring me in. But when I'm looking at large cap companies, still trading at 18 to 22 times earnings going into this. Look, anything can happen in this game. I've done it long enough to realize that markets can defy what makes sense. Markets can stay irrational longer than you can stay solvent. I just cannot wrap my head around the idea that again, I'll just go back to valuations. When valuations are attractive, I think that's when you start buying.
That's Zach Abraham in Seattle, Washington, and this is Retirement News Online.